Number 1. The Monday Morning Wire. You manage $517 billion in pension obligations for 1.8 million public employees across 7 states. It is 6:23 a.m. on a Monday in October, and you are reading a Bloomberg terminal in an office on the 41st floor overlooking Lake Michigan. The European Central Bank announced a 50 basis point rate cut 12 minutes ago. Your fixed income allocation just shifted $4.2 billion in theoretical value. You have not moved. Your coffee is still hot. You are running scenarios in your head about what this does to your duration exposure, your liability matching strategy, your funded ratio that the board will see on Thursday. The phone on your desk shows 11 missed calls. You already know what they want to ask. You already know what you will tell them. The terminal refreshes. Asian markets are opening. You have 600 employees across 4 offices who will arrive in the next 2 hours expecting direction. The wire services are writing headlines about volatility. You are calculating whether to rebalance $18 billion in sovereign debt before London opens, or wait until you see what the Fed signals tomorrow. Your predecessor retired at 61 after his 3rd heart event. You are 47. You have been in this chair for 9 months. Number 2. The allocation committee. You sit at the head of a table with 9 other people on the 3rd Thursday of every month. The chief investment officer to your right manages $140 billion in public equities. The head of alternatives to your left oversees $95 billion in private equity, infrastructure, and real assets. The woman at the far end runs a $70 billion fixed income book. They present recommended allocation shifts. You approve or reject decisions that will compound across decades for people who will never know your name. Today, the real estate team wants to deploy $3.8 billion into a European logistics platform. The IRR projection is 11.2% over 7 years. You ask about the Brexit exposure. They have modeled 3 scenarios. You ask about the Polish political risk. They have not. You table the decision. The room goes quiet in a way that means something. The meeting continues. Later, your deputy mentions that the real estate head has been at the fund for 19 years. You have been here 9 months. You approve the deal the following week with additional covenant protections. The relationship resets. You are learning what power looks like in this room. It does not look like saying no. It looks like saying yes more slowly. Number 3. The liability structure. You spend 6 weeks in year 1 building a model that no one asked you to build. The pension system has a weighted average liability duration of 14.6 years. The current asset portfolio has a duration of 8.2 years. This is a $180 billion gap in present value terms if rates move 100 basis points. You cannot close it quickly without destroying returns. You cannot ignore it without failing the mandate. You hire 2 actuaries from Milliman and a derivatives specialist from Bridgewater. You construct a liability-driven investment overlay using interest rate swaps and treasury futures. It costs $240 million in upfront margin and ongoing roll costs. It reduces the funded ratio volatility by 40%. The board does not understand it. The external auditors flag it for additional disclosure. The union representatives ask if you are gambling with their retirements. You explain that you are doing the opposite. You are paying $240 million to remove a bet you inherited. They do not find this comforting. You stop trying to explain. You include a 2-page summary in the quarterly report. You move forward. 18 months later, rates rise 200 basis points in 6 months. Your funded ratio stays stable, while 3 peer funds drop below 70% and make headlines. No one mentions your overlay program. This is how you know it worked. Number 4. The private markets. You allocate $82 billion to private equity, venture capital, infrastructure, and private credit. You do not pick the investments. You pick the people who pick the investments. You commit $500 million to a fund manager in Menlo Park who has returned 24% net IRR over 3 funds. You commit another $300 million to a middle market buyout team in Chicago with a 16% IRR, but better discipline on fees. You spend 4 days in Singapore meeting with an infrastructure platform that wants $1.2 billion for Asian renewable energy projects. The projected returns are lower, but the diversification benefit and ESG scoring are higher. You approve $800 million. The board likes the headline about clean energy. You like the inflation protection and the fact that the cash flows start in year 2 instead of year 7. Everyone gets what they need from the same decision. This is most of the job. You are invited to closed-door meetings where you see deals 6 months before they are announced. You sign NDAs every week. You know which mega funds are raising capital, which are having LP troubles, which are quietly winding down underperforming vehicles. You know this because you are the LP everyone wants. You write checks that other LPs follow. You stop going to conferences where people pitch you. You take calls from 4 fund managers. They come to Chicago. You decide in the room or you pass. Your time is the scarcest asset you manage. Number 5, the political layer. The pension board has 13 members. 5 are appointed by the governor, 4 are elected by active employees, 2 are elected by retirees, 2 are state legislators who serve ex officio. They vote on your compensation, your investment policy, your external manager selection. You present to them every quarter. You explain why the funded ratio dropped from 78.4% to 77.1%, even though the portfolio returned 8.9%. You explain that liability growth outpaced asset growth because the discount rate changed. You explain this in 3 different ways. You stop explaining when you realize they are not asking because they do not understand. They are asking because their constituents do not understand. You are the face of a system that promises $31 billion more than it currently holds. The governor wants to reduce state contributions. The unions want to increase benefits. The retirees want cost of living adjustments. The taxpayers want lower taxes. You manage money. You do not make policy. This boundary is theoretical. You testify before the state legislature about the consequences of underfunding the annual contribution. You do not say it will cause a crisis. You say it will require higher returns or benefit cuts later. You show them the math. They pass a budget that underfunds the contribution by $1.8 billion. You go back to your office. You call the derivatives team. You need 40 basis points of additional return this year without additional risk. This is technically impossible. You spend the next 6 months finding it anyway. Number 6, the recession scenario. March 2026 arrives with investment-grade credit spreads at 380 basis points, up from 95 in January. Your public equity book is down $47 billion. Your alternatives are marked down $12 billion on paper, but you know the real impairment is closer to $20 billion because private valuations lag. Your funded ratio drops to 71.2%. You receive calls from journalists, legislators, and board members asking if the fund is in trouble. You say the fund is designed for volatility. You do not say that you have been running recession scenarios since you took the job, and this one is milder than your base case. You rebalance $22 billion from investment-grade fixed income into distressed credit and public equities over 6 weeks. You buy when the Wall Street Journal runs a front-page story about pension funds facing a crisis. You deploy the capital in 11 tranches because market timing is luck, but dollar cost averaging is math. The chief investment officer asks if you want to slow down. You do not. By August, the portfolio has recovered $38 billion. By December, you are ahead of where you started. The board meeting in January is calm. Someone mentions your leadership during the downturn. You say the portfolio design did the work. This is technically true. You also know that you bought $22 billion in March, when your predecessor would have sold to reduce headline risk. You do not mention this. The difference between competence and courage is often just knowing what the model says to do and doing it while other people are afraid. Number 7, the successor question. You are 52. You have managed the fund for 5 years. The funded ratio is 81.6%, up from 76.8% when you started. The 10-year annualized return is 9.1%. Against a 7.5% target. You earn $840,000 in base salary plus performance incentives that vary. You could retire. You could move to a sovereign wealth fund in the Middle East for 3 times your current pay. You receive these inquiries twice a year. You do not return the calls. You are running a different calculation. The pension system needs another $60 billion and 12 years of 8% returns to reach full funding. You have the model, you have the team, you have the board relationships and the political credibility, and the scar tissue from doing this through 2 recessions. Someone else would need 3 years to learn what you know about how this specific system operates. 3 years is $18 billion in compounding chop. You stay because leaving costs more than staying. This is not sacrifice. This is accounting. Your deputy is 41. She runs the same calculation you ran at 41. She will leave for a smaller fund where she can be the CIO. You will hire someone younger who wants the apprenticeship. The cycle continues. Somewhere below, in an office on the 18th floor, a 29-year-old portfolio analyst is building a model that no one asked her to build. She thinks this job is about picking investments. You remember thinking that. It was never about that. The markets open tomorrow. You have $517 billion in obligations to people who are teaching 3rd grade and fixing roads and fighting fires. They do not know your name. They will retire on the decisions you make on Tuesday. You run the scenarios, you make the calls. The system continues.